G'day expats, welcome to another episode of Expat Chat. As always, joined with my co-host, colleague, mentor and friend, Brett Evans, who is the Managing Director for the EMEA region. Oh God, that was silky smooth. How are you going, Brett? How is the sandpit?
Hey, summer's here. Life goes on. Luckily the place is pretty well geared for it. I'm sure those who've been to places like Montreal would understand the reverse to what we go through. They're covered in snow and very cold weather, and we're covered in very hot weather. So, it is where it is, and maybe just get on with the job. So, and to folks out there who don't recognise the voice on the side I'm talking to, joined by my mate and colleague James Ridley, who's the Managing Director for the Australian office that looks after clients in the Asia and Americas region. Mate, how's Oz? All well?
Mate, it's well. It's cruising through winter. It's there's some days which I really love winter because you get these clean, crisp mornings. Don't like the cold, but it just seems like the air is it's so much cleaner and just clear. You get these beautiful southwesterlies that come through, and just the sunrises are just fresh, but it's just so crisp. Anyway, won't rub it in, but yes,
episode 55, mate. Episode 55. What are we looking at?
That's it. Today, I want to talk about when expats return back to Australia, repats, and they move into an investment property, and then it's treated as a main residence.
They've never lived in it before. They've bought it overseas as an investment property, and now they're coming in. So, mate, sounds like a good topic to me. Once again, the disclaimer: all the information that you're about to hear come out of more so James' mouth than mine is going to be for informational and educational and entertainment purposes only. Please don't construe this as personal financial advice, and please speak to a professional.
Absolutely, mate. Now, we'll jump into it. So the context of this is, okay, we bought an investment property maybe whilst we're an expat and we're returning back to Australia and we're going to move into it. So it's been rented for a few years. There's a few things that go into it. And I suppose, assuming they bought an investment property after 2012, it means that there is going to be a period there that is always going to be taxable by the ATO. I commonly hear expats refer to it, when we move into it and establish it as a main resident, that just turns the asset into being tax-free now. We don't need to worry about when we sell it. That's not true at all. Not true at all, especially if it's been an investment property first.
5 to 10 years previously, 100%. Anything historical. From that point they move in, they're not tax-free, but there's always that liability in the background.
Yeah, absolutely. And I remember having some calls with people and sort of going through the process of, explaining, okay, these are sort of key dates that you need to keep in mind. But yes, when we move into an investment property and establish it as our main residence, going forward, any capital growth that accrues on that property, that's tax exempt and that's fine. You're benefiting from the main residence exemption then. However, later in life, when you sell that property that's, say, been your main residence for 15 years and maybe an investment property for 5 years, well, that 5 years that you owned it as a non-resident, always taxable. And the way that tax is worked out is there's actually a few methods. And most accountants, there's two methods that they can use to, I suppose, calculate how that capital gain can operate there. I think the most common that they like to ask you is get a market valuation as of the date that you return. Really going to help them do some easy sort of, I suppose, numbers. Quick calculations. That's right. Some quick math, but it just helps segregate. So one, it helps segregate the ownership period of you being a non-resident. Two, it helps sort of have the firm buy purchase or purchase amount. And secondly, the sort of the market valuation of when you date. And they can almost use those figures to do the simple calculation. But one other thing that comes into that calculation is, well, you've owned that property for a number of years, but you've also owned that property for a number of years as an Australian tax resident. So you do get a portion of that gain being discounted. And that's something that a lot of expats aren't aware of. So there's, again, a few things that go into it. Okay, market valuation helps segregate period of you being a non-resident. The fact that you've owned it for a number of years now as an Australian tax resident, that can help discount the capital gain to a degree. And again, any capital growth after that date that you arrive into it, move into it, yes, tax exempt. The other calculation method, which accountants like to use, is just pro-rating based on days. So if you had a property, you didn't get a market valuation on it, and then you sold it, then they're just going to ask you, okay, what was the buy price and what was the sell price? And now we're going to use a pro-rata fraction, or a percentage, and apply that to the growth based on the days you owned it as a non-resident and it was rented out as an investment property versus the days that you've owned it in total. And then they're also going to work out the portion of the days that you owned it and lived in it as a normal main residence. So there's a few ways accountants can work it out, but you'd think it's actually a very easy, clean calculation, that one, but it's not. Done it a few times. But yes, there's a few ways that can apply. But one thing just to bear in mind, that moving back into a property after you've rented out for a number of years as an investment, it doesn't just reset the whole thing into being tax-free. No. I think that sometimes can be a bit of a myth out there, unfortunately. And
sometimes
I guess
people don't find out till after the fact they've sold, and they go, "What's this tax bill?"
Yeah, absolutely. And it's a case where, yes, definitely need to be mindful of it. There's not too much planning you can do around that. It's just a case where when you bought the property, yeah, it was an investment property, you rent it out. There's other things which can impact capital gains and cost bases, and that can be things like even depreciation. Has its pros and cons, but I'm not going to go into that. That's a bit more complex.
Capital works.
Capital works, improving the value, absolutely, especially if you do some renovations. I wouldn't want to be trying to get a builder to do anything for you right now. I think the wait time would be 5 years, the way the construction industry is going.
And you'll pay $10 on the dollar when it comes to the cost of materials as well, and the labour.
That's it, mate. That's it. So, I mean, taking a step back, yep, moving back into an investment property, that's fine. Always best to get a market valuation as at the time that you move into it. That can be done historically, but to give you an example of the difference in cost, if you moved into a property, say August this year, it's been an investment property for a number of years, and now it's going to be your main residence. If you got a market valuation done, in September this year, that might cost you a couple $100. If you're getting a market valuation in 10 years' time, well, that might cost you a couple of $1,000. Yeah. Market valuations don't expire because they're just done as a snapshot in time based on historical data around recent sales in the area. You can file that away in your emails, and you can use that later in life when you eventually sell it. Give it to your accountant if you're sort of someone that uses the same accountant forever. But that's an important takeaway. There's not too much planning you can do around that. Sometimes, yes, adding some value to it, writing them off in the early years as part of the tax deductions with it being a rental. That's sort of what a smart investor will do. But moving into it, there's always going to be a tax event attached to that main residence. Absolutely.
So don't forget, and this will depend on how far you sell it after you move back into it. But, there are a number of strategies, as you say, you can manage that tax liability. The biggest, lumpiest one, concessional contributions into super, using the catch-up concession, those allowances. So don't necessarily just pay it if you think you have to pay it, because, there might be some options there to reduce it anyway. So,
that's a really good point, Brett. And the only other strategy that you could employ, but there are strict conditions, is the downsizer contribution. But again, there are strict rules around that. Usually you need to be a bit older, closer to retirement, allows you to put up
maximum
to
account balance.
That's right. Yep. Transfer balance. That's exactly right. So usually allows you to move 300,000 into super. But there's a lot of criteria you need to tick off to be able to satisfy that. But that's a pretty handy one as well.
Yeah, no, it certainly is. And I think that's, it should never preclude you from making a decision as long as you can manage the outcomes. If you can manage the outcomes and you're happy with the result, then fantastic. But like we always say on this podcast, be forewarned is forearmed. We're just seeing a lot of folks who aren't aware of how this, this tax demarcation affects people moving back into an investment property. So I think, to me, it's quite succinct. It's virtually boots on the ground when you're there, when your suitcase is on your bed in your former investment property and you're living in it, then from that period on, it's tax-free. In a very weird sort of way, we actually hope that clients' properties don't go up in value while they're a non-resident, because therefore there's no liability in that period of time that they've held it. So in a very sort of altruistic way. But mate, I think we leave it there. I think we've pretty much covered that one there. So thanks very much for that. We'll see you on episode 56 next week.
Sounds good, mate. Speak soon.
Thanks, mate. See you.